Hi everyone, today we're going to talk about RSPs. Specifically, we're going to talk about whether or not you could contribute too much in your RSPs. Whether you have an RSP or you're looking to start an RSP, that is something that you may be wondering. Now, let's start with a definition of an RSPs and some of the benefits of having one. An RSP is a registered retirement savings plan, and as the name suggests, it's designed to help Canadians save for their retirement, and it provides certain tax advantages. For one, there's tax deductions. Depending on your income bracket, you may be able to get tax deduction and reduce your taxable income. In addition to that, while the money sits in an RSP, it grows tax deferred, and there are contribution limits, right? So you could contribute a certain amount, 18% up to your earned income, but there's a maximum limit. For 2024, it's 31,560. Nonetheless, if you have unused contribution room, that amount gets carried forward and you could use that in future years. And I have a whole another video about RSPs, so you can check that out. But that's just, more or less generalization, nice little overview of what RSPs are. Now, let's talk about the suitability and effectiveness of an RSP. Well, when are you going to really use an RSP? It's usually suitable for individuals who make at least $50,000 a year. But in addition to that, you want to be strategic about using that because you could contribute to an RSP, but it may or may not make sense. Why do I say that? Because, for example, if you're making $50,000 now and you contribute to an RSP, and when you take that money out, you're earning $80,000. You're going to get taxed more than you would when you contributed at $50,000. So essentially, you want to make sure as an individual, when you contribute, that you will be in a lower tax bracket. And in many cases, you're pulling that out in retirement than when you contribute, right? So that takes some strategy on your part. So just because you have the option to contribute to an RSP, you should at least consider when you're going to take it out. No, things happen, uh, times change, and situation come up, and you may have to pull it out for different reasons beforehand. However, for most individuals who are saving for retirement, you want to be conscious of that, right? Because quite frankly, what happens is that many retirees may end up with a higher income. And the reason for that is because you have multiple sources. You have CPP, you have OAS, you have a private pension, right? You have different accounts that you could pull from, or you have income that you may have not even considered. You may have investment property, things of that nature. And so what happens is the effectiveness of the RSP depends on not only when you contribute and the benefits you receive, but also when you withdraw those funds and the benefits that you receive at that particular time. And quite frankly, what you want to do is contribute when you're in a higher income and withdraw when you're in a lower income. Now, you do get the benefit of tax deferral, but from a income perspective, income tax perspective, it would not necessarily be the best way to go about it. So what if you contribute a significant amount, right? What will happen is at some point that money has to come out. It could either be from a RRIF standpoint, and a RRIF, it will be established the year you become 71, your RSP convert to a RRIF. So you have to convert your RSPs into a RRIF the year you turn 71 before December 31st, right? Before the end of the year. And once you convert that over into a RRIF, a minimum amount is required to be taken. So while you have the RSPs, you could go without pulling any money from it if you have enough funds otherwise. However, once you convert the RSP into a RRIF, at that point, there's a minimum amount that has to get taken out. And if you're in a higher amounts, then of course, especially if your portfolio is done well, which is the case for many people in the last 10, 15, 20 years, you'll have a significant amount in your RSPs, and that amount now translates over to a higher minimum amount for RRIFs, right? So what's the potential challenge here? For one, when you pull that money from a RRIF, it's going to be income, and you're going to get taxed on that as ordinary income. Another thing is if you're also receiving OES, you're going to have a clawback there, right? So something that for many folks, hopefully want to get, people get free money. It's not necessarily free money. It's a consideration that you have paid taxes throughout the years. Maybe not income taxes per se, but you have bought stuff, you've rented, you've done all these different things to contribute to the economy. So generally, it's not like it's necessarily free. So you could risk triggering a clawback off that OAS. And for a lot of people, anything that is OAS or CPP related, they want what's theirs and they want it without any type of clawback or any type of taxes associated, right? So what you want to do is consider how much that amount will be when it converts from an RSP over to a RRIF. So that's the challenge with having too much in an RSP. When it becomes a RRIF, high minimum amount, and you have potential higher income tax that you have to pay, and you also have to deal with clawbacks, right? So what are some optimization strategies for RSPs and RRIFs? You could, once you realize that you have enough, and this is where I think a financial plan, I know a financial plan becomes super helpful. And it's helpful because it gives you a sense of how much you really will need in retirement. No, things happen again, emergencies happen. Sometimes you have to help a family out, or just emergencies happen generally. And of course, things may change. But if we're planning and we have things in place, what you can do is be strategic in knowing how much you will need for retirement. And you could create some buffer for, through the stress test if you live longer. But even then, you have clarity on how much you will need. And so, what you can, if you realize that you have too much contribution to your RSPs, or a high amount of potentially high amount of RRIF, when the RSP convert to a RRIF, you could start to do what's called early withdrawal, or even have early conversions of your RSPs to your RRIF. And quite frankly, you could stop contributing to the RSPs, and have that money go into something else, because now you know that I have enough in RSPs. I know the tax ramifications. I know the tax brackets that potentially I will be in the future. And so I start to be strategic about how much I contribute and where do I allocate those funds. A lot of people are great at putting money into funds that do well, but they have not considered the decumulation aspect of it, the withdrawal aspect of that. And so now what you're dealing with is having to pull significant amounts and deal with that tax. There's also something else you could do. You could start to look at, some tax splitting strategies that could reduce your tax liabilities. But quite frankly, the best thing is to do have a plan in place, know exactly or have a sense of how much you'll need for retirement. And once you start to see that you have way too much in RSPs and potentially huge tax ramifications, you stop allocating funds to that account and start putting it in other places. Or if you've done significantly well in those RSPs, you start to withdraw those funds earlier. And if you're withdrawing those funds earlier, what you may want to do is delay CPP and OAS. Because if you're taking CPP and OAS earlier, while you're withdrawing those funds, you're also going to get hit with a lot of taxes, right? And so you may say, okay, what do I do with those funds? A great way to handle those funds is to actually contribute to a TFSA. It's a tax-free savings account. Now, when you contribute to a TFSA, you don't get a deduction, but it definitely grows tax-free. So that's wonderful. And even from a estate perspective, when you die, there's no taxes there also. So, additional benefits outside of retirement, great for estate planning tool. So that's what you can do instead of contributing to an RSP, or when you pull money from an RSP, you can put it over into a TFSA. Generally speaking, this is not an exact science. It all depends on your situation. It all depends on your circumstances. And quite frankly, this is where a comprehensive financial plan comes into place, because what it does is it allows for you to look at your situation and you plan not only with RSP, but you look at other financial assets and you try to structure it in such a way that you enhance the tax effectiveness and you align that with your long-term goals. Hopefully this was helpful. But to answer the age-old question, if can I contribute too much to your RSPs, you absolutely can. And that's why it's good to have a financial plan in place to make sure you know when to stop contributing to that. Have a wonderful day. See you next week.